Greetings, greetings. Welcome, market rebels, to this week's macro measure. It is Sunday, December 31st, 2023, just about 3 p.m. here on the East Coast, or right around there anyway. I'm Wayne. This will obviously be our last macro measure, which I'm really combining with sector situation. Just received word that I've got to take care of some important stuff sooner than I expected to. So I've got to get this taken care of for us, get this out, and hopefully everyone can get ready for the new year, the first trading week of the new year. Oh, I'm not getting my trusty disclaimer to pop up. That's what we're heading into now. Guess I have to do this. Looks like it is now. Trusty disclaimer. And then we're going to flash our intellectual property rights notice. And then I'm going to leave this up for a while I talk about it. And I guess I may as well just leave this up and then we'll get into things. I'll cover this just verbally. Again, I would set the playback speed to 2x. It's going to be a lot of talking here. I still see the upside potential everyone's talking about, but I do see downside too. I've got those, I think, laid out, some of the big factors that I would say are just obvious to me and something maybe to think about if you're not tracking the markets, hour by hour the way we are with what we do. But the first thing I would say, right, there's all these predictions that come out, and this is the thing that I think the timing and the path are harder, right? It's, you could say, well, this is where the market's going to, but that's fine. And you could say, well, hit my target. I know a lot of these folks are saying, well, my target was exceeded. This is, great. This has been a great year. And just remember, this got rescued late. It wouldn't have been a disastrous year as things stood in October, late October, but it certainly wouldn't have been the year that it's turned out to be in the end. So just keep that in mind, that really this game's about, not only your forecast, but managing things along the way as the price action unfolds. And that's what I'm getting at with path and the timing. It doesn't always happen. In fact, I'd say it rarely happens exactly like you envision it in your mind's eye, which is why you have to learn how to be someone who's willing to adjust. But I do think this year will be a lot like 22 and 23. Said this on Cocktail Hour. In other words, I do think you're going to have really good periods of both upside and downside movement that you can capitalize on if you're willing to. And I also would say that, which I'll get to a little bit later, I think there's going to be some periods that are not so wonderful for bulls or bears. And just knowing that would, or at least believing that's got a greater likelihood than is often the case, excuse me, I think you have to be on the lookout for things like, how do I play defense, and how do I make adjustments, and when do I make adjustments, and why? And also, you want to be able to get yourself involved potentially with some premium collection strategies as well if you're not involved in those. But right now, here's my short-term take. Excuse me. I've checked this out through some of the links that we share with each other through the week, and the CTAs are apparently fully loaded. They're all the way in the pool to an extreme again. Extreme greed has been reached on the CNN, imperfect CNN greed, a fear spectrum. So you've gotten there. We also know that the Mag 7 trade is also the most crowded trade, according to some reports we saw, or at least it's one of them. So with that in mind, I think the market looked exhausted at the end of the year. We got treated to, 2 weeks of holiday-esque trading, which is what you kind of go in expecting, and it became it essentially was what you expected. It became what you expected, but just by virtue of the fact that they were not able to really further goose, especially the Mag 7, which a few weeks back looked ready to go, and it's kind of been hit by, I think, news stories that haven't really helped it. And that package of the Mag 7 and just the indices themselves look a little vulnerable. The caution part of that is that when you try to get readings based off of holiday-esque or holiday influence action that we've had for 2 weeks now, it's hard to draw the same conclusions with the same, I think, confidence that you would during a normal market environment or normal market action. So just kind of keep that in mind. That kind of makes it a little bit tougher on you, I think. I do think that there's a hangover possible. And we did really get what we were looking for overall, but they did sort of have that sort of Friday swoon here. Otherwise, they kind of did their thing. So I do think that looking at some of these things, that hangover we talked about coming into 2024 from sort of the punch bowl being out there too much from the last few months, that does seem to be the case. A lot of the leading sectors stalled right along with the Mag 7. So it really wasn't this. It was a solid finish for sure, but it looks a little bit vulnerable to me right now. I think that the Mag 7 was on the verge of going last week, wasn't able to do it. That's telling me, right, that kind of giving you that pause that you would say, what happens next? And so I think some technical fissures appeared, and I think that, excuse me, in those, and I think you have to be on guard because it really wouldn't be crazy to see some sort of a pullback. I think that really comes down or comes up to or out to when, right? Of course, when. And so we just have to be on guard. I don't know if it'll be sooner or later. I definitely think that it could be sooner because there are divergences cropping up too. So I do see like a little bit more negativity than I expected to when I looked at the charts, reviewed the charts after the week had traded. So what I tried to get to here is that there are some good bull arguments, but there's also some good bear arguments. So I just want to keep the balance there. And as we've noted, others have noted better than us because we don't have the time. The inflation catch-up potential is there because this market is roughly trading at a 10% discount, thanks if you inflation adjust it to where it was at the all-time high a few years ago. So in other words, right, just to get back to where we were, we have to almost exceed the prior all-time highs by about 10% if you want to talk about constant dollars or however you want to phrase that. So you've got that. The next thing you've got is the fourth year of the cycle. So let me bring over or find, I should say. Let me see if I can find what we need for that. And it might not let me do this. Well, then again, it may. It may let me do it. So let me see if I can get that to show, because this is maybe one of the only pictures I'll be showing this week to try to keep things moving along. I had them somewhere. Presidential elections. Yeah, so it looks like I may have to leave at this point. What I'm going to have to do is leave the graphic, and we'll come back to it in some way. But I think I need to pick up. Let me just switch this around. I think I should be able to pick up screen 3 now, and I will be able to come back to this. Let's get that down. For some reason, it's not scrolling as well as it should be. Where is that? There it is. Should pop up for us, and I think it did right now. So yeah, that's good. So I pulled this one up, excuse me, because it gives you a little more detail, and then it sort of shows you what happens next year. So a little bit into next year. So this is really right your kind of performance on average during these certain time periods. And this, of course, would be the fourth year, the election year. And you can see that that is, excuse me, that is the lighter of the blue lines here. And so notice, right, that this definitely starts out okay, but there are a couple little rough patches here as you get going. And then you get the more serious swoon in this after the spring. And I didn't even know this really because I didn't study it closely enough, but that's kind of what my sense was, that there would be something that starts to happen that starts to call things into question. But they start gearing things up in front of, right, the second quarter concluding. They get the earnings that come out, maybe that help them, that buoys things for the most of the balance of the summer. Then you sort of have this trepidation, right, leading up to the election. They come to terms with whatever the election outcome is. They rally into the end of the year. They rally to start the new year. You then have corrective activity, and then you finally pick it back up again after that. So this is really historically how the market has performed. The S&P has performed in terms of average cumulative returns since 1932 in this election year, which, remember, is the second best of the the 4 years. So just keep that in mind, because I think that's one of your better weights on the bull side, is this is typically what's happened, and the data goes back quite far on that, right, for modern times. And at the same time, you've got what they've got, rates coming down, right? And so I wanted to bring this up while we were here, and they've got rates really, right, they're favored. There's about a 70 something percent chance that by the time we get to just in front of the election, should that go off as expected, who knows these days, right? That you've got this 1+% drop by then. So this is what the market's expectations are, just to keep that in mind. So this could get derailed, right? That could maybe not work out, and that could be one of the big monkey wrenches. But let's go back and kind of finish things up. So let me see if I can just boost this up a little bit, maybe in terms of the size of the text for everyone. All right, hopefully that'll let us see it. So just working our way through here. I think companies do a really good job. As long as things aren't falling apart, they find a way to keep things running leaner. Remember that AI hype helped get us here, but if they start that all over again, I would say buy the hype and then sell when it gets extreme, right? When it gets really, really extreme, or at least roll, right? Trim, roll, whatever you want to call it. But this is really still the same, right? This happens time and time again, where they get some big story rolling along and they get people to buy into it, and the market typically overprices how wonderful things will be faster than is really going to happen. And you get these really extreme valuations. And then, so in other words, right, it's really, you're still the same. Nothing's really changed. And you just, again, the trick is to never play the game too long. So what I'm trying to say is, if we do get another round of that whole thing happening, and all this talk comes back, and of course they all want to focus on it, you've got to probably, to really, if we get another phase like that, to really take advantage of it, you really have to buy the hype before it's real, and then just be very prudent about how you manage things. Just my tip from having seen this before, where a lot of people are thinking it in terms of common sense and keeping their prudent wits about them, and yet the market will go bonkers. I'm not predicting that. I'm just saying the potential is there for that with this type of a thing. And as a result, you just need to know that there's a very good chance it won't make a lot of sense to the degree that they start pricing it in. But it really won't matter, because, again, the money's made buying the hype and then selling it when the hype just becomes far too extreme, and pretty much everyone's buying the hype at that point. The other, on the flip side, right? So that's some of the reasons for what could happen as a bullish on the bull side, right? And kind of their arguments and what could propel things. On the bear side, you've got consumer savings are really, from what I've seen, are set to dwindle by March. And so they've helped things out, but in November and December, that flipped for some reason. That didn't keep that for me. In November and December, let me clean that up for us. That was supposed to be, I don't know why that didn't flip to that line for me. That we just passed. Financial conditions eased the most since 1980. Okay, so think about that. I'll just think about that while I finish this. Part of the perfect storm, that bears sailed into aggressively. So I think we talked about this in other videos on the weekends past. And really, I think bears I don't know what they were thinking. I said it sort of at the time. I think it just was, I'm like, really? Are they really going to start basically setting themselves up for another impaling or impalement, whatever you would call it? But they did. That's what they did. I think there were so many factors that we even said it at the time. Like, there was just a lot of factors in place that precede at least relief rallies. So I think that's what led to the super squeeze we saw. It really helped it. A lot of sort of market plumbing factors were there, and there were the wrong parties were on the wrong side in a big way at the exact wrong time. And of course, we got the rest. The rest of it is history. But this could cause a misreading, right? Because it's really convinced a lot of people that all is well. And I think you have to go along with that as a trader for sure, and even to some degree, I guess, as an investor when it persists for as long as this did. But at the same time, you still, I think, have to have a little bit of a cautionary look on things because the consumer is said to be 70% of the economy, and the economy is also said to be 70% housing related. So if you look at consumer prices, which are still very high, as are home prices, and I think you have relatively very high rates to finance these items relative to where we were only a few years ago. I think this is the whole thing. I mean, I just don't think this. I hope to be wrong on a lot of anything bearish, really, but I just feel as though there's no way this is going to be able to sustain itself at the levels that things are at. Excuse me, because um, this is why I'm thinking also that inflation just may not crater. There's other reasons for that too, but I'm thinking that rates could stay a little bit longer, higher for longer than expected because they've already done that. And I don't think that all this stuff is really completely and fully impacted along with the Fed raising rates. So my summation on that is the folks are struggling at current price levels, not the rate of inflation. Everyone seems to be loving the idea that inflation's coming down, and using that to say, well, it's over. But prices, the residual effect is that prices are still very, very high relative to where they were just a few years ago. So it's really, that's what I'm getting at. I think it's where inflation took these rates, inflation rates took prices too. That's the problem. It's not wonderful suddenly just because things are cooling off inflation wise. It's good that that's happening. It's just not the be all end all that I think is being made out of it. Anyway, I don't think growth is really there domestically and internationally. They are great at least for a couple of quarters at keeping things looking great. They are great at keeping that just getting that bottom line to essentially bridge across sort of some weak periods. So that could happen again. But a lot of these things like the rate hikes are felt on lag. Labor market issues are laggards as well. And then remember that if they do start to ease a year later, that's not a good thing. We've shown that many times. I'm not going to go through that again this week. So we know that from the work that I think the man's name was Nick Maggiulo from Ritholtz, that a year later you're down about 10% or more. His estimate's 13 historically when the Fed starts to cut rates. So on the flip side, just to kind of balance it out, kind of close with a little bit of balance on that, this year 404 is the second best of them. But as we saw, right, with the analog since 1932 and what typically happens this year, there are periods where you do need to play defense. And there are periods where I think premium collection as part of a portfolio of strategies can help you out. And so if you're thinking, you know what, it would be good to add to my momentum trading, add a little bit of that. You know, Ryan has different things that he can talk to you about. He's got different defensive tactics that we cover. It depends on what service you're in, but that's something you could bring up in webinars, and he could cover some of those things for you to help you out if you're not familiar with them. So in terms of the most likely short-term scenario, I'm looking at still that we need a pullback. I think a pullback makes more sense, but I also have seen years where when people are behind the eight ball and they haven't bought enough, they immediately start to catch up in the new year. And so if you could see that as well. But I'm going to show this false breakout situation. So I talked about that on Cocktail Hour a little bit. I'm just going to reiterate that the wall of worry is certainly there. I think some of the points people make about their wall of worry are solid points. And there are some people out there that are kind of technically oriented, I guess you would say, but they're classically oriented where they're not really they're using more of the classic tools and techniques that people like to use. Those folks, along with Elliott waivers, are talking about us really experiencing a terminal wave. And again, I think there's some good points in there, but that only does help as well. I think in the short term on the bull side, if a lot of people start reacting or acting in coordination with that, or in relation to that. I still feel as though there's some things lurking out there. I think there's some really strange things that I've come across that just uh, in mainly like in credit markets, in the banking system. Some of it's domestic, some of it's international. So I think there's that and other things that are out there that just seem like possibilities. And especially concerning is when you've got the mainstream media appearing and talking about how there could be a black swan, and you're not talking about the economic black swan. They're talking more about like some sort of a massive, alluding to some sort of a massive geopolitical development or something along those lines. And so, right, that's not normally what they do. So you have to be careful when they do make those mentions, I think. Uh, so we'll see. I certainly wouldn't be surprised by it. Excuse me. But the reality is, just like we said last week, the market has been stellar technically. It doesn't get too much better. That's the problem. It looks awesome right now, maybe with the exception of being short-term overdone, needing a pullback. But everything's really participating pretty well, as we've seen, with the exception of energy, which we know can have its own unique characteristics and reasons for why it performs the way that it does at times. In other words, this can be a very independent sector at times. But if that starts to join the bull party, that would pretty much mean everything's effectively working or recently has been working. In other words, if the market stays buoyed while energy catches a bid, there's really not too many things you can really say that aren't good about the way the market looks technically. Excuse me. The sectors, we've talked about key sectors that have participated. All of those really kind of took a little bit of a break, much like the last week. We all know that it wasn't anything special. The bond market, right? I'd say the yields have really come down clearly, right, in the last 2 months. That they seem to be pricing in rate cuts, so that does seem to be a real thing. I'm taking that seriously this time, where I didn't really take it so seriously when they were talking about it about 9 months ago when they started yapping about it. The dollar's been down. So, but there's been really good participation. I think the reminder I would have for everybody is you've just got to stay focused and avoid complacency, work the market in front of you with discipline. That would be my message, and just prepare for, if you don't know how to play defense, learn it. If you're not comfortable with premium collection, learn it, because there could be some periods where you're going to say, man, this market isn't maybe moving around as what I'm accustomed as much as I'm accustomed to. And that's because if there is uncertainty as you start approaching the election, and it's a close election, apparently in the polls or whatever the case may be, the market doesn't like uncertainty, and it can sort of take the natural bullish vibe that the market tends to exude, and it can kind of counterweight that and create, right, sort of like this range bound trading. And so when you get that, right, you can do very well. The market's bottled up. So just keep that in mind. I still think we have to keep our eyes on those. These are the big ones, of course, to keep your eyes on, excuse me. And of course, we've been saying, the DXY, especially the TNX, moving right inverse to the market. That relationship's been very good. I think I saw a report on that it's probably been the most correlated it's been in some time. I can't remember how long, but it's really been a pretty strong inverse relationship. So that's all the stuff I wanted to cover there. We'll talk about the IWM right now and things like that. But let me get into what I may do is use my other charts for now. And so I'll jump ahead to IWM. And this is a little bit about what I'm kind of cautioning about. Like this candle here, this is a weekly candle that we're looking at. So we're looking at a weekly chart, and you can see, I think, that on that weekly candle, not really a perfect candle, right? You really don't want to see that if you really are breaking out, and it's working its way through these highs that are right near 200, just below or just above 200. And it certainly did put a nice little boost together to get up and through there. We got the 205.49, and that was good. But there was really not great follow through. The problem is that after initially puncturing your way through and getting right to the high. So not really an ideal sort of follow through this week. You don't want to over read it, of course, because the problem is it's holiday trading, right? How do you read that? Do you take it the same way you would a nice, good, solid week in, I don't know, maybe like the third week of February? It's really not the same thing. So it's tough, but things got a little stretched. We all know that. And so I decided we've been having bullish ideas in here for a while. I decided to add a bear just so folks were prepared. There could be a little bit, there could be a little bit of pullback there, is what I'm getting at. And so you might get that. Now, I'm starting there because here's the look on Thinkorswim, and you can see there's a gap there. So this would be one area that it could come back to, but I think coming back, your first area will be right near the 199, which you're not far from, you're less than 1% from. So that's really kind of the you break through, you pull back, and can they find support, right? And sort of test this and go. And this is one thing about Tesla. I liked Tesla for the past few weeks. I think I talked about it on the weekend videos a few weeks back. And I think we were talking about it back in here where I added an idea over the weekend because I thought it really looked like it wanted to try to pop back up. It finally did do that, but you can see, right, this is what I'm getting at, why you always have to keep these failed breakouts in the back of your mind as a possibility. Excuse me. So unfortunately, and this is where it all, I think, comes together, where Tesla really picked the wrong time to try to do this, right? Because the market was already sort of overbought in the short term. There'd been a lot of rallying to that point. It was lagging a little bit, and the market looked exhausted. The market looked tired. And then you've got the end of year, and you have sort of like, is it really good trading then? Typically, it's not. Typically, it's kind of at best middle of the road trading in most years. And usually there's a rally, but it's not, I think they front loaded this rally a lot, and they just kind of cruise controlled it, just kept it, near the highs for the most part. The market, that is, not Tesla, but you can just see it right there. This is what I mean. Like, this is your breakout for me anyway. This is the breakout, and you came back to it here. Now they're coming back to it again. And so that's what I'm getting at in an IWM. You may have something like that. You may have this in a lot of stocks. You may have it in other major index ETFs, but you always have to have in your mind that, I'm not in the clear right until I'm really going. And this has been a relentless run. There's a lot of gaps in here. It wouldn't be crazy to pull back to the former critical area near 199. We already noted how close that is in proximity. So I think you've got to be ready for that for sure, obviously. And then beyond there, I think it's your 20-day and this gap fill. Those become, not that there aren't other support areas. I think you could easily argue that probably right near there, it's a little bit higher, about 195-ish. There's another one, but this is really the obvious area that could be gravitational with respect to the recent action. Just not a good finish, right? Excuse me. So probably any weakness there opens that up. And like I said, I do think there could be a hangover effect where a lot of people know that this market has gotten maybe a little bit ahead of itself, and also a little breathless from not really pausing for all that long and sort of really galloping up. So you might see that hangover wherever a lot of people decide they want to take profits on some names they pushed out their tax consequences, onto the next tax year. So there's kind of the look at IWM. I'm going to also go back and look at it this way too. So I thought I had this on here. I'm not sure what just happened to it. I'm kind of a little surprised. Oh, there it is. It just wasn't, it was a scaling issue. So I know that I'm going to really break with my own traditions and kind of glom onto the tradition that everyone likes, which is let's start making, projections or predictions for the year ahead. I'm going to only do it in this way, though, that if you wanted to know where could this really go to if it does take that ultra bullish course, right? The markets take this super bullish course that some people are expecting them to take. That would really put this thing the way that I would chart it. That's got that they've got this thing going up to 311. Now I don't think that's realistic, right? That this thing's really going to tack on 50% this year, but who knows, right? You just have no idea what could be coming down the pike at all, right? We have no idea what could come down the pike. So I'll give them that, but I think the immediate concern is that you kind of fall back, as we said, towards that 193-ish area. To me, that's your kind of big fallback area. If it really would be depressing for bulls if it can't really hold near there and starts to really fall apart even further, right? Because then you'd have yet another failure. And with interest rates dropping and presumably dropping further, it would be a little depressing, I think, to say, well, even with rates coming off, the IWM can't find a way to rally and really join the party in a more significant way that the SPY and the Qs and the Dow have all been having. So we will see on that. But if you really wanted to know, I'm just going to put that out there for people, not a prediction, just saying that would be the wildest, most wild number I could possibly throw on it right now, is if somehow after all this consolidation time that it's had for a few years, it finally puts it together and goes. But if you really want to be realistic, I think it's the obvious levels that you would just pick out just from prior, right, support and resistance would be about, I think, your first big level that way. If you want to get something a little bit more upside, that would be right up at 227-ish. There's definitely a level up there. Certainly there's other ones below, but I'm saying anything that's 10% or above. First one I would look at is about 227. If you're looking for something that's 10% higher than where we are now. Your next ones are right about there in my book, right? I would put that at 234. And then I would start using some of these fib levels from there. That's what I would do. The all-time high back in here, you wouldn't want to brush off, though, at about 245. So what I do, I just work with the closer by levels. And if they get there and they act well, then I just keep looking to the next one up, the next one up, the next one up. So I try not to get too far ahead of myself that way. And that way, right, I'm sort of handling things, I think, in a consistent, disciplined way, which is, to me, is important. Oh, excuse me, I'll jump back over to the SPY. We did have this on Cocktail Hour. I know that Greg was doing a good job hosting. Ryan was on the call, but he was traveling with his family to visit other family, and Bill was there. I tried to do what I could because I know folks like the look forward stuff, and I didn't want everyone to leave without any look forward stuff or projection. So we did talk about this, but if you didn't catch that, I'll just reiterate it. I've got 3 levels that I would throw out there. Conservative, then maybe more aggressive than most aggressive. And so my first level that would come into play for SPY is very close by, right? That's 488. So I think, right, SPY is at 475. We're talking really just a little bit over 2%, I guess. That's nothing, right? So that's my first one. The next one up from there is going to be at this 520 area. That's the next one up from there. And then from that point, I think you've got to go with this about 610 on SPY. And that would be, excuse me, that would be really another tremendous year. But that's where I'm leaning towards in terms of for the most aggressive that you could get to. If you look at something like this cup and handle that we've talked about, that I'm sure other people are too, 480, your low point here is about 348. So you're looking at 132. The trick is, where do you take that 132 of the height of the cup and where do you go from? Some people like to use what they perceive to be the top of the handle. Some people like to use the top of the cup. whatever the case may be, let's just throw it out there. The high here is 472. So that puts you at about 604, which actually, if you use this as the real breakout area and you tack on that 132 to there, you're looking at around 604, which puts you in the neighborhood of there. So, as I've said before many times, my opinion is that cup and handle patterns are a good pattern to spot. They do often deliver the goods, and they in terms of they do fire and go, and they're not false breakouts as much as other things that I've traded over the years. But they also do have a good kind of follow through or carry where they do get good movement. So I wouldn't rule something like that out. It would surprise me, I have to say, like just sitting here saying, well, that's one heck of a move. But just remember, and I'm sorry, the allergies are getting me as usual in the cold weather. Just remember that there's a 10% discount thanks to inflation in this market right now. So if we were to go right from say 475 and we were to go up, we'll say 500 points, you're going to be at what, 5250, which is near this one. So if you get there, you're right back in line with inflation roughly, right around near that, that 5200-ish level. Or wait, hold on one second. What am I thinking? No, it would be yeah, well, I guess 5250, somewhere in that range. And then right, if you go up from there, if you were to get a nice 10% pop from there, you're looking at probably another 15% from that point to get up to about here at where this 600 level would be, which that is a good year for the market, better than the typical fourth year that runs at about 7% historically. But is it possible? Certainly, right, with the kind of hype and support that they're sort of clandestinely, I guess would be one way to put it, aiding this market with, again, the easing financial conditions, the greatest really ease since 80, easiest conditions since 1980 by some measures. And that does always seem to, a lot of that seems to find its way into the stock market. The Dow actually has some really big numbers that, people be like, wow, but just because of the nature of how dollar expensive it is, right? Even though it's points or whatnot, but still, you get the idea. That would be in real Dow numbers. That would be about 47,444. But in the DIA, it's about 474.44. So, you could see how how that projection plays out. So that's really big upside. And again, 10% would 10% added onto here puts you over 41,000. So you're not, again, if you just look at it that way, excuse me, they're going to adjust for inflation just to get back to where they were because everything's all of a sudden, everything's wonderful again. That's really not then tacking on another, 500 points or so from there. Or in this, it'll be 5,000 points in the real Dow. Not the biggest deal in the world when you're at 42,000 anyway. But that's the number. I'll go back through all these too, just for some pullback levels as well. We'll just chart them in real time, excuse me. And the final one is the Qs, right? And so I've got different projections worked out here to try to do the same thing, conservative through aggressive. And I think the most conservative one comes out to about 445. The next one up comes to about 470, right? And that would be a really, that would be a really solid year. But I don't think you'd be all that far past. You'd be a little past the inflation adjustment level, but not even by that much. Another one that kind of comes up is the 498 level for the Qs. So those are some of the obvious levels. If it gets past there, by all means, submit a question during a webinar or a cocktail hour or in the forum. I'll be happy to revise, and probably will have revised all this stuff by then to try to reflect where things could go. But that's what I would go with in terms of if you're looking for conservative 445, 471-ish, and then 498. But again, it's certainly more than that's possible. I think just kind of going with the flatline approach that we like a lot. as many of you know, right now, my flat line would put this thing at about 383 on a bigger picture weekly view that we're working with here. So 383 is about what? About a 27 point pullback, roughly speaking, I think. Or 20, is it 20? Yeah, 27, 26, something like that. So we're looking at what's that work out to? About 5%, right? Kind of like a 5% pullback would be my first big level. If I had to look for other ones, I would probably start looking at where there would be sort of like a concentration of fibs and flat lines, to be honest. But I'm going to just keep it simple and say the next one after that would be about 371, roughly speaking. So those are the two I would throw out there. If you want, where if we get a pullback soon, where do you think it can go to levels wise? That would be those two. Let's do the same thing in the other big ones just to be consistent. Right now, again, I'm sticking with the flat line. I think you got a flat line right near there on these weeklies, and that's about 455 in the SPY. So what's that about 4%, right? Nothing extraordinary. I would say your next level after that, let's see, it might be a little bit lower. That's getting there, but probably, yeah, that's probably about it. 436. We've used that level before, so that also makes sense because I've seen that come up many times. So 436, so those would be the two there. I'll go to the diamonds and we'll do the same thing here. Maybe this will help people that really like this stuff. That to me is a pretty darn good level, at least one of them. So let's use 35,128 or 351.28 in this case in the ETF. What about, I mean, if we're using the, we should really use the Dow if we're going to throw Dow levels out, but I'm just trying to, I think you're one in front of that's about 355. So again, nothing incredible. Right there, it looks like it's about 5. That's about 5% on that one. So there's two for there. IWM is our final one. And we already talked about this one, but I think you're at 199 is your first level. You can see that there's hesitation in here. There's some candles where that held in both directions here. Other than the recent action, yeah, I do. I would say I think there's a 194 level that you would probably want to keep an eye on. And then the next one below there, probably have to go with this 189 level. And those two have also come up in other things that I've done. So both of those are levels that are sort of repeat levels that keep coming at you. And those are usually pretty good, I have to say, over the course of time. They are usually pretty good. Let's do a Mag 7 check here. So I will give us the old Mag 7, build this Mag 7 for us. And we will let's get that built. And you can see that looks really good, right? Making a new high, but the way that it finished, a little concerning. I did on some of the individual stocks, I did see a little bit of concerning action developing where if they don't hold very close nearby to some SMAs or just some recent type lows, it could invite some more selling. So it's possible, we should cover this now. It's possible in my mind, right? It's very hard for the market, obviously, with those heavyweights as a package to be heading lower. But in my mind, what could be happening is folks waited. They wanted to unload their Mag 7 stuff in the new year, and then they want to rotate into other things because they think this rally is going to broaden out, and they think that other stocks represent better buying opportunities or better values at this point relative to the Mag 7. Just throwing this out there for thought. So you could see some rotation. It could create volatility. Again, it's hard for the market to really keep printing new highs if the big dogs are really sort of being distributed or seeing profit taking, whatever you want to call it. But usually, right, if this is a real bull market, as so many people are saying that it is and will be, then you should see things broaden out, right? It should turn out to where more and more stocks start to act well, and there's going to be a lot of opportunities. So this one would be about 18. I think the first one that sticks out to me is about 1853, 1854, somewhere near there. Right now, we closed at what on this package? 1957. So we're talking about, again, that seems to me to be about 4 to 5%. So these are just simple ways of just sort of sizing things up. But this would be a failure, right? Where you had your chance, you have this cup and handle. You're looking at this weekly chart. Things look really good. Other things look really good about this. I thought they were looking really good a couple of weeks ago, but they haven't been able to do much with that. And it could just be because right, they had such a phenomenal run that they're just tired. There's exhaustion. A lot of people that have bought are content for now. Could be that they'll get more attractive after a pullback to some people. Could be that people are wanting to sell them and just rotate like we just talked about. So I do think, right, about a 5% pullback is what I would expect if we are to get one there. Just for starters, if it doesn't hold there, right, just come back and start talking to me and I'll see what I can do about finding other levels. But that's really probably the first one that I would sort of sign on to, and probably looking at something right around there at 1780 ish. I would say 1780 looks like another area, but so that would be obviously a little bit more. But this is hanging in there for now, but little concerning, right, that it didn't do more with it. Could change when we open up for trading this week, right? First session, they could change everything with a news story on a couple of them that's positive, but especially right, Nvidia and stuff like that. But anyway, you get the idea there. So still looks good with the overall complexion in the bigger picture, but in the short term, I think it looks a little concerning. So it sort of jumped into all that kind of big time coverage there. But I just wanted to share that because I know a lot of people have that in mind for what at the end of the year, kind of approaching a new year. Now, let's see if I can get these sectors going. And since we're kind of doing the joint video again this week, but I'll lift I should say lift, I'll magnify these. You can see, right, the thing stalled out, right? Energy is its own thing, still can't get out of its own way. Excuse me. But as I've been saying now, week after week, at least it's not worsening. And we have to note that it does have the chance, right, with this action still, it could even come in more, but it has a chance to have sniffed a higher high and then pull back. That's certainly not good. But if it could put in a higher low, remember, there's probably a lot of eyes on this sector right now because it's so conspicuously absent from rallying, excuse me. And a lot of people think it should have rallied by now. And a lot of people thought it should have rallied for many months and are probably frustrated by it. So it might be a little squirrely to deal with it, and I think it has. It gets tricky when a lot more eyes get on it. But if you could just keep in mind, right, if you're someone that hopes this turns into a bullish opportunity and that in some of the components within it do, you really the most critical thing could be that it just maintains the higher low status. And then you start seeing, right, the very first signs of possible trend change and joining of the market. That assumes, of course, the market holds itself together. But you can see that there were higher RSI readings on things like XLK, XLC, XLF at one point. But now we did sort of peter out the last couple of weeks where it was sideways action. Now, we've always talked about that as being, again, dual-sided where, hey, the rally's not there anymore. The momentum's being lost. That's the one part of it. But if it doesn't crack support and they start to come back for it, it actually still serves the bull's purpose quite well because that's what I just call a pause. I just always talk about pauses and pullbacks. You usually get one, the other, sometimes both, right? Where you pause, then you pull back from there, or you pull back, then you pause for a while and then start going again. But regardless, right, it's still corrective action. You're still holding on to higher high, higher low, but some things are creeping in where you've got similar highs, right? But you've got worse momentum readings. which a lot of people are going to refer to as negative divergence. So I think you have to be on guard that there has been really this slowdown in momentum. It's come in important areas, right? And also just across the board where the momentum just stalled out. And that's, again, probably due to the amazing run that we had. Certainly isn't from rates screaming back up or the dollar getting strong suddenly, because both of those were only a session or two removed from the recent lows when we closed for the year in terms of trading. So these things are a little vulnerable after the run they've had. You've got to just acknowledge that. And so just keep your eye out for a little bit of backup. But when all these sectors flash that way, you've got to say, well, the appetite to buy is starting to dissipate. It's starting, maybe it's exhausted. And the only thing that's making me a little less, excuse me, the only thing that's making me a little less concerned than I normally would be, because I would definitely be concerned after the run we've had. And I would say that we're looking to get that sort of hangover effect selling where the market, really went a little too haywire. But it's because we have holiday action, right? Is it really a lack of interest because people said, why bother trying to sit there in the last couple of weeks where nothing typically happens that's so wonderful? Let me just enjoy my final couple of weeks of the year. We're in the holiday season, and there was almost like a lack of interest, right? So don't know. It's really hard to say, but that's kind of what it seemed like to me. But here's a great example of negative divergence in a sector that's been tremendous, right? You get the highest high that we've seen. I think it was an all-time high. I put a bear side idea in this one, and I don't like trading counter trend, but I thought it was worth it. You can see that some of these very basic technical tools, right? Some of these oscillators and indicators are just saying, this higher high was not accompanied with a strong momentum complexion, right? It's actually some negative divergence there. So this is the hardest part of the whole week, I think, for me, is to say, well, is this real or not? Because I have my doubts that I think it should be real, but again, I don't want to overdo it. I think it really does look real to me, but you just always have to be a little concerned about. I didn't really trade through a real week. It was, or 2 weeks. It was both holiday weeks where there was just a lack of big time interest in the market. People were happy by and large where the market was. But XTN, it's all similar, right? Where you can see the momentum is really sort of slacking off. Meanwhile, the stock or the ETF in this case continued to either stay high or remain buoyed. And so that's the big question coming into the year for me. It does sort of suggest to me that there should be, you can see it everywhere. That's why I'm talking about these little fissures, little cracks that are showing up here in sort of the complexion of the market. And I think you have to be on guard. I'm not, as I said, right, like, I'm not apocalyptic here. I'm not talking about a market crash. I'm just saying that we are overdue for some pullback in some way. And interestingly enough, staples kind of got bid while discretionary slid a little bit. So that's a little bit of defense perking up and then offense aggressiveness getting tamped down. So just kind of keep that in mind. XLV, this one probably also has negative divergences building, and it does. You can see there's a higher high here that we made on Thursday, and versus this high barely, but this, the momentum complexion just is not as good as it was. Again, don't want to keep belaboring it, but don't want to overread it either. But there's your XLP, there's your staples compared to that. Now let's take a look at XLV. We'll take a look at healthcare. Similar story everywhere, right? Pretty much everywhere we go. There's oops, I didn't get the E in there. Hold on one second. XLRE, excuse me, and similar story, right? Double top. There's a lot of these things look like double tops. I think, just to kind of throw something out there, I think this 20-day in blue, I think that's in a lot of cases what you're looking at coming back to if they do allow for this overdue pullback, right? It's not like I'm looking for anything incredible out of it. I just think it would they'd serve themselves well, as a matter of fact, that they just were to allow some kind of a pullback there. If it doesn't hold the 20 in a lot of these cases, and more negative divergence in the financials, right? I mean, virtually every one of these things has it. And so you've got to remember, if you do trade this, there could be some nice little trading opportunities. I did try to get some bears in there, seeing what I was seeing. Um, you can see this whole sort of second hump up here versus what we saw back here, better readings the first time around rather than what we've seen here, right? So just kind of showing you that the momentum, the way the indicators are being calculated, it's just not there, right? It's that sort of like latter stage behavior more so than early stage. XLK, you could see that, right? There's just not, it didn't show up. Again, you could say, well, that's because of the holiday. And guess what? You might be right. I mean, I can't say for sure that it isn't. That's why it's a conundrum. And then energy. We'll just do this to be thorough. But the difference in energy, I think, is that, right, it's been struggling for a while versus a lot of these other things. At least it stopped going down. It tried to break out, couldn't pull it off. I thought it was going to try to work its way up to the 100, but it couldn't even do that. So, now you've got this gap in here you've got to be cognizant of, and you've got maybe, right, you start making new lows that maybe becomes odds on. Just because, right, when something's not behaving well, you have to almost say, well, the way that this thing just keeps dumping, I expect it to dump again. Now, it might not make a new low versus here, but I would say that if the market's struggling, this thing probably does work its way down. Not that there's a great opportunity there, but you get the idea that there's a little gap close that might become a little bit of a factor there. But all the sectors do really look vulnerable. The dollar, again, like I said, it's kind of the dollar and yields are sort of in a weird way. They've gotten so, you can see how that's gotten so smoked really over the final quarter of the year, from really reaching the highs in early Oct to getting absolutely smoked all the way back down right in the final quarter. That and the dollar and the yields really, again, good inverse relationship. They are a little bit, I would say at this point, a little bit overdue to try to just perk up a little bit with some kind of a little dead cat at the very least. So maybe we will see a dead cat out of those. The VIX, it's not really something I think you can chart the way you would a stock typically. But, the VIX is down near the lower levels. Ryan has been talking about, you may want to get your hands on some maybe like March, implied volatilities, and where there's some really good buys and some stocks that maybe could have a significant pullback that could maybe be a smart move, something to consider at the very least. So that's another kind of, but these are all probably due to sort of have a little bit of a day in the sun, right, where they start to perk up a little bit. The intermediate trends on all these things are still down, but you can't rule out a little sort of quick spike if we do see some sort of profit taking type motivated selling, now that stocks have made the run that they have and people waited it out and they were able to get into 2024. So that's that. Let me think about XHB. I think I've got one. Maybe had something pop up in here as well on the bear side. We've covered this in XLRE. Like, these are things to me that this is exactly what I would, if I were doing weekend seminars, things I've done like that before. Just, my seminars, I would say, things I learned the hard way that hopefully I can save you a lot of time and grief. That would be my run-on description of what my seminar would be, just things I've learned from getting things wrong or never experiencing them before. But this is exactly why I don't take my fundamental take and bring it into the market, and why I got cured of that a long time ago, because to me, like, this is crazy, that where rates are, where home prices are. And, fortunately we had some trades in here that were bullish. But if I were going back, just coming out of college, I'd say this is utter madness. And I would, be wanting to fight against this thing, but there was a lot of opportunity there on the bull side. And it makes, again, another one that makes no sense to me but I think it's a ticking time bomb there, and also in commercial real estate to a great extent. And again, hope to be wrong, but I would, these days, of course, well, for a long time, really, I would switch around and just trade it because I know that the market does a tremendous job of making people regret keeping their wits about them and looking, look in the short term, looking long term. You really don't want to do that as a trader. But sometimes it's hard to do. You got to get over that hump. But yeah, I think this is one to me that you would say, well, what the heck is going on there? But I would sort of trade this counter trend at this point. It's been an amazing run, right? The kind of action we saw in there. I wouldn't I would be super disciplined about it though, because something like this is, you don't want to fight a trend that's that strong. You want to be the person that gets in there. Maybe you get in there with a slightly in the money that allows you to roll more quickly. It comes to support and you roll like a robot because you assume right when you're in an uptrend that support will hold at least the first time. There's been many times, if I go way back to sometime in the early 90s, where I would see support and resistance and I would be willing to wait it out. But it seems like you've got to wait sometimes not only just days, but then weeks later to get back. You have to sort of endure adverse movement where you could have captured some money right away. And you have to endure adverse movement just to get back to where you were, say 2 weeks later. And talk about really poor time management, right? Rather than taking the money that was there quickly, you held on for more money, but they made you hold on for weeks and weeks and weeks and deal with a lot more adverse movement against you. So if something, if it suddenly cracked because some big news forced housing to crack, like where somehow Powell about faces all over again, or something like that, then that's a different story. But if it's just normal trading, it gets to really a level where you'd expect it to really have a good shot at finding support. You take the little bit of money and run, maybe you roll on some of them, some of your puts. If they don't work out, you get out of it right away and just set a trigger to re-enter if there's another wave lower in the future. That's how I would handle that. But we do have some ideas here and there that are now bearish. I had a hard time, luckily too, really, I had a hard time of late getting too many bearish ideas in the services because you all know what's happened with most stocks. But I think it's time to at least where you can latch onto them, just be ready for some. I'd be very surprised if we were just, up, say 5% in January with no look back. Can happen, but I would be surprised about it. What else? Oh, let's take a look at GDX. And I think what we were doing before, though, actually, I think what we did last week is we found out we were better off looking at GLD. So let's look at the big picture. And I just want to do the reminder on here that, especially now if you start to adjust gold and silver, due to inflation should also be higher, right? So if you get that, right, you've got the cup and handle that everyone is probably seen that's interested in these. It's got that potential. So, just remind yourself that these are tough to trade, but if it does really start to catch that bid, they can make powerful moves at times. The problem with these is that they make powerful moves that are you're just like, wow, that was incredible. But it then becomes like those in my experience are few and far between. So they're just not really consistently great traders, but they do have their moments. And it seems like they're coming up on one like that, where, if they're going to really shine and stand out, it ought to happen, you would think, relatively soon. And usually the dollar heading down helps them as well. And that's been the case. But here's the junior miners, and this is what I mean. There were times where there'd be amazing moves here and there, but this is looking back, about 13 years, and you could see that every few years you get something a really good push to the upside, but the rest of the time it's not all that wonderful, right? So you kind of need to just nail these things and then move on to other things that are more interesting. But we typically talk about those to some degree at times. We talked about other things. I'll take a look at crude just for the sake of taking a look at crude to go along with our energy. But I mean, this has been the XLE and this have been fairly fairly correlated. I would say that they've been I think XLE at times has acted a little bit better than crude, but you can see that also looks again looking vulnerable, just like XLE on the daily right there. So yeah, it is what it is. What else have we looked at? Was HG that we were getting the copper from? Let's see what we can do with copper. Again, I've been coming back to this at times, sometimes covering it week after week. A little bit better, right, than what we've seen it do before. You got to like that, but now, right, it's kind of gotten to the top of its range again over the last, few months, and it's looking like it could crack there, right, a little bit more. So just, I know no one's probably trading it, but right, you would really want this, and I think energy to start looking really better than they do if you were convinced that there's this global rebound on the way, which I hope there is, by the way. I don't want to sound like I don't. It's just that I'm having a hard time buying all of it yet. And again, hope to be wrong. What's our other? Let's take a look just to see at what these ETFs look like. And they were doing better with housing, wood and cut of late. And I've got too much data that I'm pulling. So but you can see that got a little haywire to the upside. So that's another sort of, in my book, like that became overstretched, right? That's probably due to start backing and filling a little bit here. So maybe, right, just kind of that end of year punch bowl exuberance. Same thing here, not predicting that, hey, it just collapses, but you can just see that is overdue for a pullback. Those are some of the other things we look at. Let me think if there's anything else. Oh, you know what? We should really look at semis. I can't even believe I did not look at semis, but these I think became tired looking. And you see the same thing we've been seeing in a lot of other areas where you can see this slightly higher high that we make here, second bump, but the indicators, the oscillators in old classic stuff, just basic stuff, they're not buying it, right? They're saying, oh, there's the momentum's not there. Now, the one thing we can say is it did not crack support, right? So give it its due, but it's right there, right? It's really close to, I think, cracking it. It's on the verge. I think you're right to me. Like there's one line there. That's probably your line for me at the moment. And you've only got the 10 and 15 that are supporting it, right? And those are not down too far. So your 10 and 15 SMAs in white and red respectively. Other than that, right, there's not a lot of flat line around here. Opens you up to work towards the light blue 20-day. That is down at 169, roughly speaking. That's about, what, 3% away. So again, another one that says 3%, others say 4%, others say 5%. I guess it just depends on, what asset you're looking at, but that's what it sort of shapes up to be. And that really wouldn't cause, I don't think, massive damage, right? In other words, I think it would still have a trend that would be intact, because if we were to take the lows from here to here, it would be right near trend, I think. Not exact, maybe just a little below there at the 20, but right near trend, intermediate term trend. And then that doesn't hold. Of course, we started looking at flat lines. We look at the 50 SMA there in gold would obviously be the next one up. But there's a little bit of vulnerability, I think, entering the year. I think that's the key takeaway. And it's just a question of, I would say, again, if this were the third week in February and we were through, let's say it's not an earnings season, maybe I should be saying the third week in March, I would say, look, this thing probably pulls back. I would be leaning a little more strongly towards we get a pullback. My only reservations are fresh buying to start the year. And the other reservation, of course, is that what we saw the last couple of weeks was really more of a, wind the clock down, time things out. So we mark out high more so than like a listless market. It was listless for sure. It's just that, was it listless because people would rather commit starting in the new year, and they were like, this is it, I'm done. It's been a great finish to the year. For now, I'm happy. And holidays typically have lighter volume and lighter interest and so on. And so I don't want to extrapolate too much on that. So I think on that note, I'm going to wrap things up. Let me just double check and make sure we don't have anything else here we forgot to talk about. Yep. So I'm taking things more seriously, like I said about the rate cuts. I still kind of feel like there's this chance of something falling apart out of the blue. I think we saw with IWM, right? That's going to be a key thing. If that'll sort of tell you if they're willing to start really bidding those up, those smaller companies, then there really is a lot of confidence that this economy, they're putting their money where their mouth is, or at least your money, other people's money where their mouths are, and saying, look, these other small companies are going to start to do well as well. We're not worried about problems. We're not worried about financing. We're looking at it and saying, no, these guys are going to start to fire too. That would be a great sign. I'm still kind of a little leery on it, buying that story myself, but I hope to be dead wrong. XLE joining would be good. Commodities are apparently a great value historically relative to stocks. Those joining would be good if the global demand starts to pick up. And I do think there's big time potential in the silver, gold right now, because when they fire, they've got a pattern. But if and when that fires for real, that could really produce stuff. And the Mag 7 to me is the key thing too. You've got to keep your eyes on those, of course, but they kind of whiffed on their opportunity to really make great progress and finish the year strong. I think they were set up to do that a few weeks ago. They sort of passed on it, and now they're all looking a little concerning. Let me just show that, and then we'll wrap it up because we're on the daily chart here. Let's just go on a 1-year daily. We'll just have a nice little chart. I'll bring them all up, and we will wrap up on that because I know these are of great interest, but I think you can see what I mean there, right? Apple, I'm sorry that Thinkorswim's getting me on this, but come on, guys. So there's the price level. You could see that that's not a good close, right? That's one of our worst closes in a few weeks there. It's a big dog that could portend, right? There's going to be more pullback potential. Certainly Apple pulling back, not the best thing. Amazon, you can see the SMAs are almost rolling over, potentially crossing. You're not too far from the 20-day there in Amazon. That would be the light blue line at 149.82. And there's definitely, there's flat line support, but the space between the 20 and 50 visually, that's fairly significant, right? So if we're going to do more of a SMA test, the 20's got to hold. Otherwise, that's really starting to lose a lot in a lot more significant way. Meta, this was looking really good, but you could see that a lot of these sort of stalled out and reversed, and that's right near the 10 SMA there in white. You bottomed at just in front of it. This is exactly, by the way, I'll use this as an opportunity to hit on another one of my reminders. This is why I would tell you to always bid in front of the obvious support and offer right in front of the obvious resistance levels by a little bit, because you have a lot of company of people that want to buy it just there, right? So you got to sort of get in, sort of like butt in front of those people. But look, a little overextended up in here, right? It's still even, it did come off nicely. Wouldn't be shocking, right, to have it come back down a little bit more. It's only 2 sessions there after the run that it had. So again, looking a little vulnerable. If we start just on this one, I might do it on the other ones too that remain. But we just drop a support line across on here, you could see that crack there. So cracking the 10-day, you should be concerned. That's 351.16 right now. Microsoft, this one to me was a little perplexing because it's sort of been consolidating. I thought this was going to get on its horse. I was waiting for a breakout here. I thought they would at least put a breakout attempt together. They've yet to do that. But it is hanging in there. But, until it leaves this recent range, probably got to get above 377, 378 to really start thinking it's on its way to something bigger. But it's also, right, it's also kind of in a danger zone until it does. So, it wouldn't take much to knock this thing below the 20 at 372.58. It's only 1%. That starts inviting a visit right to lower flat lines like 366, and then the at 50 SMA at 363.57. So you can just see from the look at this stuff right now that, and I always skip over Google for some reason. You can just see that these are not looking as good as they were, and they really didn't have a great finish to the year. I thought Google was going to get us into the mid 140s. I had an idea in there. I think the idea worked out overall, but just another disappointing sort of. It was a good little idea, but not that kind of like gangbusters jam job you were hoping for. It's had a nice little pullback to the 10. It held right on the 10 right there. So that does look decent. It's kind of broke out above those. This is the kind of a flat line that it broke out above right near this 130, call it 38.50. So it give it its due there. That's probably a decent little flat line, near one at least. So if it holds there, fine. But if not, right, one below that Friday low is a problem, right? So that could turn out, which is not far away. That could turn out to be a problem fairly quickly. Nvidia, this one was also, I thought they were going to try to put this, given what this year's been about, I thought they were going to try to get this a little bit closer to the highest high of the year back here, but they did not. And so again, this kind of has its own like little mini cup and handle happening here. It still has an uptrend. You can see that. And that could be the thing that really ignites the still right higher, higher low here. And that's good. This could be something obviously that ignites the whole market. If it ignites itself, it could ignite the whole market for sure. And a lot of this could be suddenly shift right back into super bullishness. But notice, right, the lack of interest here. Like in terms of volume, it was really kind of dead. And that again, that's what makes it hard. That's why I'm saying you might get some of that this year if the market is indecisive or does not know what to expect in terms of the there may be periods of that this year if we get into sort of that summer area heading into maybe SEP and OCT, and you might want to think about premium collection. Not just then, but that might be an obvious time where you might want to have that premium collection arrow in your quiver, or maybe a few different kinds of approaches to premium collection. But anyway, that doesn't look so bad, but obviously you need to hold Friday's low there. And then finally, we'll look at Tesla, and we'll wrap it up. This one, again, I was thinking they were going to get a little bit more of a push than this. I really was excited about a Tesla trade that we had somewhere, can't remember. It did sort of fire nicely to a degree, but you're right, I was thinking more or less like it would come up and at least challenge those highs. Didn't do it, didn't do it. So kind of all part of that end of year sort of, right, things got tired. But that's why I always say you really can't be comfortable, even if you're starting to get the breakout that you want. And it's ideal to have the market's wind at your back, and the market lost that wind, right? It really was itself was winded, so it really didn't have that oomph that it had earlier in the fall. And so you got that kind of a sort of whimper type of a finish to the year. And that type of environment, without really strong stock specific news to drive it, that makes it really hard to just sort of sustain a rally, a really strong rally. And that's what we got there. We got that sort of breakout and then return back towards what was formerly resistance. Maybe they'll try to convert it to support. Then again, maybe they'll fail, who knows, but that's what we're looking at right there. So a little bit of a mixed bag on those names. And as a result, right, if they do all sort of suffer a little bit more of a pullback that they are kind of hinting around that they may have, that could definitely weigh on the markets and weigh on them quickly in a significant way. And like I said, I would say between 3 to 5% from what we saw is about fair, right, for what we think in terms of just a reasonable short-term pullback. And then we see what happens from there. So on that note, I'm going to wrap it up. I do hope that these videos helped you in 2023 in some way, or they'll help you in 2024 or another time in the future. We try to do the best we can under the circumstances. Let's see what else is there. Yeah, so I want to wish everybody, I hope everyone had a great holiday season. I hope everyone's found a way to remain healthy. I hope everyone remains healthy in 2024 and also has a prosperous year. And I think one key, like I said, to that is to really do, if you're still finding your way as an options trader, is to just keep getting more and more comfortable with different key components to success. And I think being a really good position manager is probably, for me, is probably the most important. And that includes playing defense, And then, of course, being a portfolio manager, and that includes other strategies that are not necessarily as correlated to market movement. Maybe they're, in fact, uncorrelated or inversely correlated to a degree to market movement. But if you can run that kind of an approach and get it down pretty well, what we found is when you run multiple strategies, there's some things that just pop out, and one things that pops out is that you get a little bit more of a consistent P&L when you're not, which makes sense if you think about it, when you're not sort of one strategy focused or one mode of trading focused, and you're multi modes. You have different things you do. You can smooth out your performance a little bit that way, and get better performance, I think, as a result. So just something to think about. So I want to wish everyone a great conclusion to the weekend. Great wishes for 2024, and I'll see you all in the webinars, in all the newsletters, cocktail hours, everything else that we do. So thanks again for tuning in, everyone. Take care.